Welcome everybody to the Thursday edition of the Not Your Average Investor Show. Today, we are getting the CPA's perspective on why this stuff may or may not make sense to invest in from somebody that knows JWB's numbers better than anybody else, the controller of JWB, who is also an investor. I'm your host, Pablo Gonzalez. With me today is Rich Neel, controller at JWB, former New Yorker, for at least a little while. A brief period, New Yorker. One of those here. Let me get you there. Nope. Okay. One of those data points that remembered how good Florida is and came back down. Surfer and Moose Lodge treasurer and past star of the show. Rich Neel, welcome to the show.
Thanks for having me.
Good to have you back. Good to have you back, man.
I believe it's been 3 years.
3 years.
Yeah.
Insane how much this stuff has grown. You'll see how much wackier and how different it is.
Okay.
It'll be a very different experience. And as always, our amazing community manager, we call her MTM because she brings us the moments that matter and because her name is Madison the Magnificent. Say hello, Madison.
Hi, everybody.
We like to tell everybody that if you're joining us on the podcast, you're joining us on the YouTube channel, anywhere else but live here, we have this thriving community of folks. We get often 100 to, I guess weekly, what, Madison? What's our average now? Like 150 to like 170 people a week.
Mm-hmm.
We get in here. So if you're listening out there on podcast land, in YouTube, go to nyais.com, sign up for one of these live shows. We do this live on Tuesdays and Thursdays. Come be part of the community and be part of a little tradition that Rich is about to learn about. Rich, you know what I'm talking about?
I believe it's called roll.
The roll call, baby. All right. We got our leadoff hitter, John Henning, kicking us off today. We got the ringmaster of the Not Your Average Investor Show community, Drew Barnhill. We got Lita Song from Minnesota. Lita, we got to come up with a nickname for you because you're showing up every day. We love it. We got our regulars, the Rileys, Gary and Rosalind from Murrieta, California. We call them the second family, and we regard them every time they show up. We got Allie King, future star of the show, in here. We got Big Papa in the house. We love it when he calls in Big Papa. Greg's dad, Jay Cohen. We got Leo Faraganan, Faraganan, that little way to remember how to pronounce his last name we came up with. I think Jen Filson came up with it. We got Layla Powell in the house, teammate, superstar. We got the maven from the mountains of Denver, the real estate maven from the mountains of Denver, Leslie Wilson. We got Robert Jones back in the house from Atlanta. Good to have you back in here. We got the mama bear of the community, Cody Adams, in the house. We got Louis Hunnell from formerly Milipitas, California, now rocking in, what is it? Rocking in Rockland, Louis? That's where you moved to? Good to have you. We got the Shaw man of the Not Your Average Investor Show community, Nadeem Shah, in the house. And yeah, man, that's been a tradition that's evolved since we started doing these live shows.
That's very cool.
First time you were here, we were just on a couch with a production crew.
Yeah.
A little different.
I got equipment. I got gear. This is intense.
This is real. And we also have another tradition that is my favorite part of the week, which is when Madison shares good news. Madison, what's the good news?
All right, everybody. So at JWB, we have a little slogan. We like to say that you're either growing or you're dying. And I just want to congratulate, I'm sure they're in the audience somewhere, 5 people that decided to further their education and take advantage of our flash sale and buy the course at that $99, which I think is a steal. So just want to congratulate you guys, David, Sarah, Steven, Gregory, and Guido.
I love that. I love that. I wonder if it was the slick used car salesman pitch that we used.
Had to be.
Normally $9.97, now for $99. That's pretty hard to turn that down, right? Yeah. So congrats to you all. Happy to have you in the community. I think it's, what is it, over 200 something people, 300 people that have taken this class, that are part of this. Yep. When you come here, you take that and then you get real versed on exactly how to have success as a real estate investor. You can find that class at notyouraverage.com.
Yep.
Right. All right, cool. I'm getting that
Very
right.
Cool.
Yeah. Rich, maybe you want to take a little class one day.
Sure.
All right. Sounds good. All right.
$99.
$99. Well, it was $99 on Tuesday. Now it's $997 back to the standard price.
Still a value.
Still a value for years of wealth creation. Madison, you know what I call that, right?
Good news.
I call that good news. Thank you so much.
Of course.
All right, Rich, you are back. This is a very different show now. It's a different world since last time you were here.
Indeed.
January 2020 to now, things have changed. And let's go over a little bit of your backstory, right? How did you end up as the controller here at JWB controlling all this stuff?
So I will have to say, I know the intro was a little misleading that I was a New Yorker. As a native Floridian, that rubs me a little bit the wrong way, but I was a New Yorker for a brief period of time. I'm from the Gulf Coast where I was born and kind of shipped myself off to college up in New York. Iona College, go Gales. Knew I wanted to do accounting, knew I wanted to see if I could work for one of the big firms up there, work in Manhattan. Did all that, knew the whole time I was going to move back to Florida at some point. The CPA rules back then were actually a little bit less stringent in New York, but I still sat for the exam so that my license would transfer down here. And the people up there thought I was crazy. Why would you sit for all 4 parts at the same time? You know, this and that. But anyway, and not to the minute that I got my license, but as soon as I got my license, I started looking to move back.
Okay.
And so it's interesting, I didn't pick Jacksonville necessarily because this is 1997 when I moved. I didn't know anything about the real estate market or investing. I was still under 30. Under 30,
so, yeah, late 20s.
But I knew I wanted to be back at a beach. I knew I didn't want to be back on the Gulf Coast or that close to my parents. I had a sister that was working for UNF and a brother here that was working for Barnett Bank, and he lived in Ponte Vedra. And back then I stayed with him, and you can imagine Ponte Vedra was completely different in 1997.
Yeah.
JTB, I believe, was 2 lanes coming into town. But so I found a job here with public accounting firm, was sold in one of my visits here. They took me to a Jags game. I grew up a Bucks fan. I was like, wow, this is what a good football team looks like.
That's right. Late 90s Jags were good. Late 90s Jags were good.
Jags were good.
Yeah.
So anyway, worked in public accounting here for a couple of years. Then in 2000, you kind of make that change in your career when you're in public accounting. You either, am I going to be a public accounting lifer or am I going to go, a lot of times you go work for one of your clients.
You were at Enron, right?
I was at Anderson.
Anderson. Yeah, I knew it was one of those.
Yeah, so I was not at Anderson. Yeah. They just blew the whole credibility of that. Yeah. But no, I actually got out of Anderson. I had a job offer from Regency Centers here in Jacksonville. I still remember our catchphrase: "They're the largest owner and operator of grocery anchored shopping centers in the United States." But I literally got out. I got the job maybe a year before the whole Enron thing went down and Anderson crashed. So I was very lucky. But I've always done tax. So tax is my background. So I was in the tax department there, and then got the opportunity at Regency to be their corporate controller, which exposed me to the whole operations. And even though it's commercial, it was eye-opening to see, here's this publicly traded company, this giant company, and they were based here in Jacksonville. Yeah. And that's where they got their start, Regency Square, the whole nine. So that was really where I first kind of got exposed to the real estate market, and again, commercial. But I was there for 13 years, learned a ton, and had kind of hit my, kind of the zenith of my career path there. I guess you could say. We were having kids are getting older. It was getting hard with my wife and I. We actually both worked at Regency Centers. That's a whole other show. But as the kids get older, juggling 2 full-time hardcore careers, I went through Pivot CPAs, who a good friend of mine who hired me at Anderson was like telling me, he's like, dude, you've got tax background, you've got accounting background, you got your CPA, now you've got this real estate background, you've got corporate controller background. He's like, you should go out, do your own thing, be self-employed, and kind of do this controller CFO type for hire. And he introduced me to one of their clients, JWB, and I met with Adam Regal. Yeah. And they were looking to hire an accounting manager. And as I got to know, I was like, I think I can do what you need done for the same amount of money in less time. Basically. Yeah. And all the guys at JWB are willing to try anything outside of the box. And he jumped at it. And this month is literally my 10 years. Okay. So 2013. 2013, September 2013.
Interesting.
So yeah, that's how I got here. They were over on 2406 University. I walked in, they were having TMM in a kitchen of a house, basically.
Yeah,
Um,
I want you to paint this picture for me
yeah.
right now, right? Because I think everybody now, when you were here for the first time, and I'd love to know in the chat, has anybody here heard Rich's original episode? It's one of the first 8 episodes that we publish on the podcast. If you go back to the total beginning, you get to hear his whole origin story, and we dive much more into it. But paint a picture for me of everybody here knows now JWB as this big company, right? 100 employees, Fortune Inc. 5000 fastest growing companies, best places to work, Ernst Young Entrepreneur of the Year Award. When you
Gator 100, don't forget the
Gator
Gator
the Gator 100, multiple lists. Yes, thank you. Where when you walked into that company, then talk to me about the difference between how they came across and what it looked like from the outside in, to like how they came across and what it looked like from the outside in now.
The core values that their core values really haven't changed, which is impressive. Same entrepreneurial spirit, same sense of family, just grown exponentially. The thing that has always impressed me about the guys that run this company is just what they did and the risks they took to start it, the confidence that they had in what they were doing, and the confidence in this market. And even now with all the success, they're still thinking outside of the box. I'm still trying to keep up with the unique deals that they're doing. And it's not even just with the business, with the company. It's they have vested interest in all of the people that work for them. My story, there's countless of, there's a ton of their vendors. Ian McKillop, their attorney, was one of the friends that they talked to go out on their own. Whitney Ritchie, their insurance person. Nick Scrutz, their maintenance. There's just so many of those stories where even if you're not working here for the if they take that personal interest in you to think and challenge you to think outside of the box and continue to grow. So it's literally the same, just on a much larger scale.
Yeah,
it's pretty impressive.
I'm glad you brought that up, man, because when I was re-listening to our episode, I remember you bringing it up, and it was my first aha moment of like, oh man, these guys are kind of like a business incubator around town.
Yeah.
And thinking at the time, I don't know if you know this, right? But at the time, I was just starting my company back then. They were my first client. And I was just like, man, I hope to grow up to be like Rich and have a company 3 years later, which I do now. Right. Yeah. So it's like, I'm now one in the line of these businesses that they were able to see, bring in as a strategic partner, demand the best out of me and make me a better version of myself. Seeing into their operation and seeing into their business has greatly inspired me on my views on leadership and the importance of core values and culture and all these different things. Right. So I'm super happy to kind of come back to that conversation now, 3.5 years later, as I guess I'm a success case in that path too. When you first joined in, you had and we're going to get to your investments, right? So spoiler, Rich is an investor. He has a portfolio of properties here as well. We're going to talk about those. But you were coming from the commercial real estate background. How well did you understand the residential real estate? And talk to me about kind of your learning growth of understanding this thing from where you sat in the seat as a controller first, and then we can get into the investor side.
Yeah, so I had full transparency. I was 100% old-fashioned, conservative with money. Debt is bad. Put everything into your 401k. I sat through all those max out your 401k. It'll grow. Put it in the stock market. My first experience with really residential real estate was when I bought my first house out at the beach and just got tired of throwing rent away. And just for somebody who's good with numbers and math, I was still blown away by the fact I forget what year it was, but I was shocked at how much a bank would lend me based on, I was making good money with Arthur Andersen, but I was like, you'll lend me what? To let me buy that? Oh, okay. So that was really my kind of first foray into residential, but my investing strategy was it was it was by the book, diversify,
Mhm.
but through mutual funds, the stock market. It wasn't until here when I learned about their turnkey business, and really Greg had me take over the turnkey client ROI report. And that was really the kind of big eye opener, because you hear about people that are flipping real estate and buy low, sell high and all that. But this model that they built for long-term investment strategy was kind of eye opening.
Mhm.
And what flipped me was seeing some of these returns and seeing the properties that people were able to purchase with not a whole lot of capital up front. If you leverage it, 20% down, and using the bank's money as opposed to yours. That was really kind of the eye-opening thing. And I'm sitting there and I'm looking at my 401k statement, and then the next month I'm publishing JWB's client ROI report, and I'm like, what am I doing?
Yeah. How long did that take? Like, how long from when you were here till you bought your first rental property here?
It was right at about 3 years.
3 years.
Right at about 3 years, not quite. But then we put my plan together, 3 properties over the next 18 months, and I've been super, super happy. And it still fits into my, kind of diversified, kind of traditional investment, because that was one of the things that was so attractive to me, was the passive investment part of it. Because I'm not a property manager. I'm not going to mow lawns. I'm lazy. I'm inherently lazy.
We're surfers,
And then when I heard that I could own actual real estate, and that's what I did, is I had Regency stock from my time there, that just it was good stock, had a good yield, nice dividend and all that. But when you look at the physical real estate, and now that I'd been here in Jacksonville for over 10 years and just seeing what the market has been doing in terms of just growth, just population growth, business growth, and real estate growth, it is like I can still participate, have an investment in that real estate sector. So I'm still diversified. I have something in the real estate sector, but now I have a hard asset. Now I have a real asset, and it takes that home appreciation component into it that, like I said, unless you're buying Google stock, you're not going to have the appreciation that we've had here in the market over that period of time. So that was really kind of shifting my mindset from that traditional, I own stock, I own mutual funds and real estate, to why not turn that into actual real estate. And I am the dream client for JWB. It's been 7 years now, and I have never seen one of my properties.
I remember you said that before.
And I don't plan to. I'm sorry. That's just it works well.
I get it. I'm the same way. All right, I want to dig into a couple of those things in there. You said that this still fits into your traditional portfolio way of investing. We've talked a decent amount on the show in recent history here of like the 60-40 portfolio and, whether that works or not, of stocks and bonds. Where do you see, and if I heard you correctly, you were saying that you were getting exposure to real estate in your stock portfolio, but this is a more tangible, higher upside exposure. Yep. These investments, where do you see them as a person that is a numbers guy and like a risk assessor? Where do you put this? How do you think about it when you're thinking about your total assets and things like that?
Oh, like when you're, kind of if you're doing that, where you're at, like you said, the 60-40, stocks, bonds, that.
Yeah. Yeah. Like, is this a bond for you? Is this a stock for you?
No, I mean, that's the change in that mindset is it's now, this is my, this is 15% of my retirement portfolio. Where I'm at, so I turned 50 this year. It's one of those things that when my wife and I bought them, we looked at them, as really, cash neutral, while we're paying off the mortgages. But as we get closer to retirement, it kind of fills in that fixed income, that fixed income bucket. And So yeah, that's the good thing about it, is that it doesn't necessarily fit into that stock bond. I now I have, and with private lendings, and I have debt, so it's basically just expanded the number of pieces on my pie chart, basically.
Yeah, I like that. We've been talking a decent amount lately about how there's people look at investments as like growth investments or cash investments. And the idea that this asset class is like a cash growth investment, right? Like it continues to grow in cash flow over time. Even in retirement, you're going to continue to grow in cash flow over time in this asset class. And it's interesting how you broke that out. It's a different, it sounds like it's just in a different bucket.
It's in a different bucket for me, for sure.
Yeah. So out of that being said, it also sounds like you didn't have just cash laying around. You just decided that you were going to take from the stock bucket that was getting the real estate exposure, cash that out, and put that into this new bucket. Is that
correct?
What I heard
That's
correctly?
Correct. Yeah.
How did you think through that decision? Did you have to think about like tax ramifications and future things? Kind of like, did your financial advisor tell you were crazy? Kind of talk me through making that decision and pulling that trigger.
So from a tax standpoint, there were, I had owned, the Regency stock for several years. So there was a cost to it, but looking at the performance and looking at the potential in this new asset class, basically, it was to me a better investment. It was just a straight up better investment.
So you just compared apples to apples. You're like, this has more upside, less risk, like just a better investment.
Yeah.
Okay.
Yeah. I wasn't, running Argus models or anything.
Yeah.
It was just, and I felt comfortable with the company. I'd been here with JWB for a few years. I worked with Regency for 13 years. I know they were a very stable, very successful company, but also, seeing the vision and kind of having that behind the curtain availability that I was lucky enough to have, of just knowing and seeing the growth in the first 3 years that I was there and being clued into where they were going in the future. I was like, this investment makes a whole lot more sense in having JWB properties in my portfolio as opposed to, somebody's stock.
Yeah. So you just looked at it apples to apples and you're like, over the next 30 years, this is just going to do better. I'm not going to, like worry about whatever. I'm going to move the money because I understand that this thing's just going to do better.
Yep.
Awesome. I was about to ask a question just like this, but Marilyn Cotterman just chimed in. She's from Homosassa, Florida. You know what Homosassa is famous for? It's the home of the manatees, Rich. That's where you swim with manatees.
Oh,
so
okay.
she's put it on the map here on the Natural Average Invest Show. So Marilyn's asking, curious, do you think you would have ever decided to buy rental properties if you hadn't been around JWB?
That's a really good question.
Yeah.
I don't know. It all kind of
talk me through what you're thinking.
Yeah, it all kind of dovetails into it because it was such an education of getting like just the old school mindset that I had, growing up and going through, college and my career. Like the first with me I like to think I would have, because I was smart enough to go the self-employed route and take advantage of my skill set. And luckily I had people around me that guided me and helped me and gave me other options and opportunities to go. And I definitely would have at some point, because actually before I bought the turnkey properties, I actually had an old 401k with one of my, that was just, it was doing absolutely nothing. I mean, single digits ever since, single digit returns, for forever. And that was kind of where I actually got, so I'm a private lender as well. I took that and just put it into private lending, because that was, again, simple math. And so I had already kind of started down that path. So I like to think that I would have, because I had already started that, I'm not going to say, 100%, because it's been such an interesting journey. But I think once I got out of that traditional mindset with my career, it helped me start thinking, it helped me start thinking differently with my money and with my investing. And maybe if I didn't find JWB, I would have found something, something alternative. And, I like to think I would have, run into Alex and Greg or somebody somewhere out in Jacksonville Beach, and they would have sold me on it. So
that's an interesting take, man. What I find, I want to dig into it a little bit, but what makes me smile is this idea that you are correlating this thought of like, I started thinking differently, which opened up my aperture to think of something like this, which is really the theme of the show, right? The Not Your Average Investor show, right? Like that was one of the things that we thought about when we started this whole thing. It's like, I think everybody here just needs to, at some point, be like, I'm just not like everybody else. And that's why I'm open to things like this as like a core concept that we all connect on. And it's really something that's really galvanized our community. The education piece and the trust piece to me are so big, right? Because you talked about it. It took you 3 years. It took me about 1.5 years of hosting the show before I jumped in. And it was like conversations every single day, seeing these returns every single day, seeing people that are succeeding with it, like Ken and Lee and, all these folks that are part of this community all the time, where I'm just like, man, okay, I need to get in on some of this, but needed to have the educational side. And that's a big part of what this show is all about, right? Just like contextualizing, educating, but it's really hard to quantify for me, which is something that I tell people all the time, because you can educate people on the numbers and there's always like, but what if, what if the company sucks? Like what if they go out of business? And it's really, really hard for me to quantify for people how much it affects my decision-making. What we were just talking about, seeing how this machine is operated at the level that it's operated by the people that are in leadership and the talent they have gathered around them is something that, we strive to show on the show and like the tours that we do. But talk to me a little bit, just the amount of, you said it, the amount of how much it pushed you, seeing behind the scenes, how much you think that helped.
Well, it's funny, you just, something clicked in my head when you said that, and this is going to be, I know this is going to turn into like the biggest JWB commercial for now, but
that's okay.
As I just started kind of thinking through the like when I left public accounting to go work at a private company, that's all I knew was public accounting. I'm taking a risk now, and this to me is a risk. But I trusted the people that told me, hey, Regency is a great company. They've got their roots here. They've got their roots here in Jacksonville, the Steins who run it. It's a big company, but they treat it like a family. And I was there for 13 years and still have very good friends from when I worked there. Then when I had the opportunity to leave that and take an even bigger risk and go self-employed, I had my buddy Peter, who had done it. He started his own accounting firm, and I trusted him. And he tells me, he's like, dude, you need to do this. This is a no-brainer. And he referred me to JWB, so there's that trust there. And then, even coming here and seeing how this has grown and if people have gone on, it comes back to they do a 1-question survey. I get a 1-question survey. That's another reason why I love JWB. I only get a 1-question survey. It's super easy. It's, would you refer JWB to somebody else? When they're dead. Boom. Absolutely. But so it's seeing that and seeing that trust that has helped me do different things and think differently. But it's always been, Regency is a great company, dude. You gotta go self-employed, and I like to think, even as that referral network is how, you've got all these people now on this podcast. It's like, dude, you're missing out. You gotta, these guys are great. You gotta trust these guys. So that to me, it's just funny. That's the survey just popped into my head.
Yeah. In marketing, we call that the net promoter score, right? Yeah. And what you bring up to me is another thing at the core of this show, that this isn't just a podcast. It's a community, right? You're just talking about this idea that like every other human being, you are influenced by the people around you, right? So you needed someone to validate Regency in order to like go work there and like it, to go on your own, somebody telling you that, up close, right? Like, this is what we try to do here, is break down the barriers of getting to know other people like you that are doing this stuff so that you can see yourself in those shoes. I think is really, really important as well.
Yes.
For me, it was the Richies, right? Like, I don't know if you remember this, but Whitney and her husband are very close friends of mine since college.
Oh, okay.
And they're the ones that first got me investing in private lending here as well. And I also had the complete gap on the education side of it, right? Like I invested in private lending in like 2014. It came due in a year. I just pulled it out. I was like, well, I'm just going to keep this money in my pocket. It's cool. Like, oh, thanks for the $2,000 or whatever. Right. When I'm like, God, if this show would have been around when I was doing it, I would have been like, oh man, let's roll this thing into a property and keep growing that thing. So that's cool that you call it out. Marilyn wants to know, had you read Rich Dad, Poor Dad?
I had not.
Have you now?
I have not. I'm probably going to turn into the worst commercial for JWB. I don't know. I've been on this podcast twice, and it's probably the second podcast in my life that I read like Game of Thrones, Dungeons and Dragons.
I got you.
So it's
the world building
as a numbers guy. When I'm reading, I have to go completely to the.
Don't feel bad. It took me like 60 podcasts before I read Rich Dad Poor Dad. So you got someplace to go, but you already got it. You're already doing it, right? Talk to me. All right. I got a couple of questions here from anonymous attendee over here. Let's see okay. So this is cool about your career. What's the most challenging aspect of being a controller in the investment sector? Like, how do you navigate that?
It's not necessarily I consider it really the real estate sector. With this, the challenging thing was how this company combined the real estate sector with the investment sector. I had some experience with looking at returns on some of the projects and some of the underwriting on some of the shopping centers that were being built and developed or purchased at Regency, but I'd never seen it connected to the turnkey and property management business and seen that synergy. So really for me, and not to get too technical, the challenging thing was not just understanding, as a controller responsible for the accounting of the company, but also getting brought in like with the client ROI and with the property management company, we're basically doing the accounting for the investors. So that was probably the biggest challenge just with my traditional brain is, hey, we're doing the financial statements for the company, and literally what we're doing with our, with the monthly statements that we send out to our investors, we're basically doing the financial statements, on a much smaller scale for all their investments. So that is a very difficult thing for a traditional accountant to kind of get their brains around, and that's it. That was also probably one of the reasons why it took me so long to even invest, was it probably took me that long in my brain to understand the accounting and get that comfortable with it.
Interesting.
Yeah. And so I'll even give props to Mike Wolfel, the new CFO here. He's been here not even a year yet, and he's somehow picked most of that up here in like less than a year, and what took me 3 years to go. So I don't know. He continues to impress me with just saying that out loud and seeing how long it took me to do it and watching him do it now. And I'm like, oh, awesome. Somebody else understands it. It's
interesting. Cool. How do you explain to people what JWB does when you're like, I work at JWB and I'm the controller over there? How do you explain it?
It's a turnkey real estate. It's a turnkey real estate company is what they are at their core. And then I have to explain what turnkey is. Turnkey is that soup to nuts real estate service, where a real estate investment service, basically, to where they'll help you acquire an asset. They will help you finance that asset. They will then turn around and manage that asset for you. And then they have all these kind of ancillary businesses, with the private lending. And then now over the past few years, where they've really been building up kind of their own portfolio, now it's like, oh yeah, and by the way, they're also becoming one of the biggest landowners and owners of operators of real estate in Jacksonville in general. So, they've got their core business, but then, oh, by the way, they have this now ginormous long-term hold and properties that they are going to own for the long time, investing in the growth of Jacksonville in general.
Yeah.
And it's good. It's a win-win, because as Jacksonville continues to grow and they're investing in these properties that are around, properties that are going to become turnkey investments, or they're kind of secondarily driving the value there, not only for themselves, but also for their investors. So it's the explanation over the years has evolved from,
right?
They're a turnkey real estate company to, now they're property management business, which I think the guys told me that we've got with the assets that are under management now. I believe it's gone from the letter B is involved, to $1 billion of assets that they're managing. So Greg
told me that too recently. He was like, because he's like, hey man, I haven't really updated you, but when we first started working together, I was like, we're a $150 million company and we manage roughly around $750 million in assets. It's now like 1.2 billion. I was like, oh man, that's crazy.
When you're dropping the B word, it's
real. It gets real quick. That's interesting, man. I describe it as these guys have figured out how to completely take owning long-term real estate and turn it into like owning a bond kind of experience, because they acquire the property, they build it or renovate it. They are the ones that fill it with a tenant. They manage the tenant. They manage the asset. They tell you how it's doing, and you just get to, sit there and do it. But now and then it's kind of like two sides of it, right? Because now they're also owning 20 city blocks of downtown Jacksonville. And the way that I tell that story, I'm just like, man, I'm from Miami, where it got notorious for these developers that showed up and developed this urban core, took all the money out and left, right? Whereas like this is this like super unique situation where people that are truly like placemaking in the urban center have this very long-term vision because of two things: the idea that they own all the stuff around it, so it's all going to go up, so they can give this thing time because they're benefiting short-term and their clients benefit short-term around them, and because they all got young kids that they want to like live here when they get older. 100%. It's super unique. Let's talk about your actual investing journey, man. So you got to JWB about 10 years ago. You took about 3 years to invest. So I'm guessing somewhere around 2016.
Yep.
Talk to me about like the order of operations of buying your properties and how you thought about them.
So we did a sat with Greg when I was like, I'm ready to invest. And, we did, I think he's got the same, the tools are a little bit slicker now, but we sat down and talked about what my personal financial long-term goals were first, because that's kind of the starting point to see if it's a fit. And then you kind of put your buying plan together. And that's what we did. And with the niche I was trying to fill, it was the kind of that magic number was 3 properties over the next, over the next 18 to 24 months. And, so that was timing of the cash flow, selling stock, putting money aside for the taxes on that and rolling it into these investments. One of the big deciding factors was, they were just getting into new construction. There was a new construction versus the renos. And, knowing I was going to hold these assets, super long term, I went the reno route on all because the returns were higher. Yes, the maintenance costs down the road are going to be more, but my kind of philosophy on that was, I know I'm going to own these for a long time. A new construction home is only going to be a new construction home for, for a certain period of time. And, I knew with my own house, honestly, that I'm really feeling it now that I'm 16 years into my house. It's not a new construction home anymore. But so that was kind of how I made the evaluation and the decision point on the 3 properties. And it's really been, kind of a textbook, a fairly textbook case, over the life of it. The properties have done really well. They started out really well, but then, 2 years ago, I kind of went through my first property turn, and I had 2 very significant, kind of maintenance issues. One of the hurricanes that came through, it blew a tree over. It didn't hit the house, so there wasn't insurance involved because there was no damage to the house, but we had this giant tree, just in the middle of the year. And it's amazing how much it costs to have a tree removed and cut up. Had a plumbing issue that was expensive, and HVAC replacement. So I had that upcycle. And then had a couple of instances where, I had to make a contribution. The owner portal that we helped design and build, that I was testing, to make a 20-cent, owner contribution just to make it work. Now I'm on the website making my own owner contribution. I was like, man, this kind of sucks, but but it worked great. But now, we've gone through it, and we're back on the uptick again. And it kind of dovetails into, as you're going through these initial buying plan conversations, like, man, I'm really not ready to commit to buying 3 houses. Like, that just, it's intimidating. Like, if I'm buying 3, but then that's where the leverage comes in, and where you look at, over the life of an investment like this, you're going to have ups and downs at all your properties. And sure, the one that was going through trouble, when that, the other 2 were helping, we're helping carry that. So, the negative returns on the one, yes. So the returns of the whole portfolio weren't great. But it really did. It's that diversification of the portfolio, different parts of town. It's been up and down, but when you go back and look at it, it's still a really, really good investment.
Yeah, this is why we talk a lot about it as a portfolio, right? Because it is what you described is the idea that over time, it's all going to do well. In snapshots, maybe one house is having a down year, but the other ones that are cash flowing are helping you pay that. And you're also, benefiting from the growth of the market and all that stuff that's going down, and it really tempers it. And you had what sounded like a normal good run of occupancy, and then 1 year where it all just kind of like all compounded together and then back to normal. So I guess talk to me through the hard stuff, man. Like when you were having that one down year, were you, I've had like my one, property that has had some trouble, right? Like, was that a conversation with your wife? Like, should we still be in here? Are the best days behind us? Did you have the long-term mentality because you're here? How did you help navigate the stress of that part of it?
It wasn't necessarily because I was here. Again, I go back to, even before I got into real estate, I knew enough about, whether anything that's a decent investment, whether it's the stock market, whether it's real estate in a good market, whether it's, whatever, it's going to have ups and downs, but you have to commit to the long term. And at least at my age and where I was at financially and professionally, it didn't matter that Blockbuster moved out and Regency stock went in the shitter, sorry, I didn't know if
that's all right.
It didn't matter, because I knew I was in it for the long haul, and I know the market, the market corrects itself. It's the same to me with rental real estate. I know there's certainly people aren't going to stop moving to Jacksonville anytime soon. No. And they're going to be they're going to be renting. Yes, it stinks. Now, it's a lesson in money management as well, though, because during those good years, you need to either put it aside or make sure that you have some other investment that's liquid, that's part of your, to be able to foot the bill if you need to. So, that I'm sure can be, that's luckily again, with my background, I kind of built that in. But that can be, I can see where people would panic, would freak, but I treat it just like it's an up and down on the market, and over the long haul, it's going to pay off.
Yeah. I want to, this just kind of like 2 components there that I think makes sense to just kind of like reiterate, right? It's the idea that you can either be putting away the cash flow that you're making and have it in something that, like you have it there available, or you just have a rainy day fund and just have that there and not touch it. Just make sure that you have that there, because inevitably stuff will happen. But more importantly, I love the way that you compared it, because this is something that GC rails about all the time. It's just like, man, this is a very normal conversation with us on a run on a Tuesday or Thursday morning run, when you've just like, I am convinced that if we can hold the reserves for people, and when it's time for like these downswings, we're just managing that transaction and it doesn't hit them, then nobody's ever going to freak out, because it's just like the stock market. In the stock market, you see your stuff go up and down, but because you're not physically sending in the check, you don't feel it. And yet your net worth takes a much bigger dive than it would if you just have to cut a $5,000 check, $7,000 check, something like that, right? Like,
that's a good point.
You're losing major points. So it's like, if you're thinking about it, like you look at a stock portfolio and just like, this is what I'm worth right now because of all of my investments, and you just have it segmented over here emotionally, then people would have a just completely different experience. So we talk about this all the time of like, would it make sense to bring people on and just tell them that they also need to, put another 10 grand that we manage or not, or this and that, in order to avoid that feeling? Because if you can take that away, then you're really just setting yourself up to hold this stuff for a long time. And like you said, it's going to perform better. It's going to give you better cash flow at retirement. It's way less volatile. So I love that you compared it to, stocks go down. Yeah. It's just the same thing.
Well, and now I got a new HVAC and a new roof, so what I'm certainly not going to sell it now. I just bought myself there another 10 years of no maintenance for that, for what I just did. So,
totally. You ready to see how well it's performed?
Sure.
All right. Yeah. So this is full disclosure. When I told Rich that I was going to show him these things that we do for everybody, he's like, I put these together for everyone, man. So you can't surprise me, but I think we can. Here we go. Let me share this real quick. So you have the 3 properties, Rich. And when you look at your 5 profit centers, right, it's broken out total. This is since 2016, right? So total net rental income on your 3 properties, you've had $37,530 in net rental income. Your tax savings is $27,579. Total principal pay down, what your residents have paid down for you passively, $30,000, and then $236,000 in home price appreciation that time. You just kind of giggled at that one. Tell me more.
Well, no, it's sick.
Just a massive amount of money, man. Over 7 years. Of course, the inflation hedging, consumer price index, inflation's been doing its thing. You haven't been having to worry about that very much. But when we break down the pieces of the pie, this is the thing that we like to show a lot of people. It's like, when you look at it by profit center, most folks, when they are investing in rental properties, they're really concerned about this one, this net rental income. But when you look at all 4 profit centers here, it's always a Pac-Man. And the mouth of the Pac-Man is everything else. And the Pac-Man itself is where people really build the wealth, which was that massive home price appreciation number that you received, which looks like this. You had an initial JWB investment of $371,000, 563. Your returns have been $322,949. Your current portfolio value 7 years later from when you started is almost double. And your actual IRR has been 30.8%. Not a bad little run for you, man.
Not a bad run.
Sounds like you were right about that whole, it's a better investment. What do you think when you see this, man?
No, it's awesome. It's awesome. It's always good when the numbers validate, validate the story. And it's, obviously blessed to have been, in the right place at the right time, you could say, but sometimes you create your own luck too.
And you still got to take the decision, right? Like I know I was in the right place, right time. But I still had to be like, okay, I'm going to do this. Let's set up this call. Let's make this thing happen. And I love when I do this show, I'm like, I like going back to my wife, be like,
yeah, right.
See, look how good we're doing.
Yeah.
Couple more questions here. Anonymous attendee asks, what do you think holds investors back from expanding their portfolio into single family rentals?
I'll just like from my demographic as I don't know what generation I am, but from my demographic of people who kind of came through, the kind of the boon of the stock market. It's just that it all depends on what your kind of financial acumen and education, and I don't want to say upbringing, but what you grew up with,
What you were exposed to.
what you were exposed to in terms of how you make money and how you can retire and live a financially stable and financial life. I think in alternative investments like JWB have become more popular in the past 10 to 20 years. So somebody 10 to 20 years younger than me probably doesn't have the same hesitation to pull the trigger. But I think at least in my demographic, because even the people that I've referred, peers of mine that I've referred have that have kind of gotten on board. It's just that same conversation. Well, what if my tenant moves out? What if and I'm like, you have to put it in that context of, every investment is going to have its ups and downs. It's just, do you believe in the fundamentals, and what set of fundamental investments do you want in your portfolio? And it does. We know like it doesn't work for everybody. There was a period of time where we sat, where the accounting team sat next to the salespeople, and you hear them all the time, like, this isn't gonna work for you. We're like, well, I want to do, I know a great yard guy. I want to do my own maintenance, or what, I think the market's gonna crush it for the next 5 years. So I only want to hold on to it for 5 years, and I don't want to sell it. And then this isn't the investment for you.
Yeah, then you're not investing with the same thesis that we have.
So I think it's just your philosophy and your mindset would be the things that make people hesitant, but I think there's probably that with any sector. I'm sure there's, well, I was gonna say that's probably a bad analogy. I was gonna say, I'm sure there's people that made a lot of money in Bitcoin, but that takes a certain philosophy.
If they cashed out,
right. So I think it's, yes, what you're exposed to. That's a much better way to say it.
Yeah, excellent. I agree with everything you're saying. To me, kind of what echoes in everything that we talked about. It's one part education, one part social validation, right? Like the more people know about it, the more normal, like the more they understand it. And then if you see other people doing it, then it becomes more normal. And then the last piece, I think, is just ease, right? Like I think Bitcoin, seeing a whole bunch of people do Bitcoin, and then I do Bitcoin is easy because I can just like push a couple buttons and go into Bitcoin, right? Like, and I really think that what JWB has done of start a platform, create a community that you can educate the public and see it while building a giant machine that makes it easy in the background.
Yeah.
To me, that's the key, right? Like I think these like 17 years of doing this and getting to the point where because of technology, the education is much easier to arrive to, right? Like, and disseminate and whatever, because of technology, the idea of like meeting other people that are also doing it in a Zoom chat, getting their number, knowing that they're a real person, like having like meeting them in the Facebook group, stuff like that. That's all happening. But in the meantime, they've been building this like capacity to really just take the pain out of it, which is, I think, what is truly brilliant about the business model is that idea of really making this thing passive, which is what brought you and I to it. Because as entrepreneurs, I don't have time to go plunge a toilet.
Right. Right. You're exactly right.
Cool. Last question here. I think this is an interesting one, man. Oh, actually, you know what? Jim Kirko is in the house. Jim Kirko is we refer to him as a Hall of Fame first baseman because he's got like a very baseball sounding name. I don't know why, but he's not. Him and his son watch this show. It's really cool. Jim says, is Rich planning on buying more properties in the current environment? What are his new concerns compared to when he started investing in single family rentals in 2016? I was just asking you this before the show.
Yeah. So it's a combination of kind of some stuff that I've got, going on in my, just financially, personally. Like I said, I mentioned we've been in our house 16, 17 years now. And like everything in our personal house is needing to be replaced. In the past, 2 years, I've had to get a new roof. We've got 3 HVACs. I've had to replace 2 of them, windows, stuff like that. So I like where I'm at now, balanced. And, if you'd asked me maybe 2.5 years ago, I'd say, you know, I have a near-term plan because I have some extra capital that I can deploy and put into this other piece of, you know, and grow this piece of the pie in my whole thing. Well, a big chunk of that has gone away of that extra capital. So that's just with me personally. And then from a market perspective, obviously the home prices, you know, the home prices are through the roof. So that makes you, you know, your expected returns start out a little lower, but it's one of those things too, where you compare it to alternative, you know,
where else are you gonna put your money?
to alternative investments. You know, I don't pay that much attention to the stock market, but I know, you know, between COVID and all that, you know, it hasn't exactly been crushing it. You know, I don't have a specific plan in place right now, but it's constantly on the radar. It's just I don't have the capital that I thought I was going to have to deploy for future purchases.
Got it. You know, if I can also just reframe that in a specific way, just from what I've heard you say, you are allocated in the places that you want to be allocated to.
Correct.
Right. So like you have the exposure to real estate that you wanted, you have it in these assets, and you have it in your own home. So you've taken the capital that you were going to expose to real estate, and you're happy with your allocation to a certain extent. It just so happened to go into your primary residence this last time around because of a couple of things.
Correct. Now, if any of the four guys are on the call, let's say, well, do take out a home equity loan and buy 3 more houses, you know, so.
I'll be on the next show.
Yeah.
So anyway, so Jim, I hope that's a good one, but I think what Rich said is important. It's like, do you have exposure to the real estate market to the level that you want to be exposed to it, right? Like as far as like, you want a certain amount of your allocation working as hard as real estate works for you versus other things. And if that's a no, then that's a different conversation than what Rich is having. And then, you know, because if you didn't have that allocation and exposure already there, then maybe you'd be thinking about like you did originally, which is you moved from one bucket to another, right? But it just so happens that right now your buckets are in like where you want them to be. Yeah, but anyways, but that being said, look at other things. Yeah, really great question. That was the first thing I asked you when you walked in here. So I'm glad you got to, Jim. All right, Rich, good stuff, man. Your return was a triumphant one. What'd you think? What'd you think of this?
That was a blast.
Different experience with the people here asking questions, right?
It makes me, you know, you could see as part of the conversation. It makes me, you know, it generates thought, it generates conversation, and you know, what do they say? If you're not growing, you're dying. So
not growing, you're dying. That's our core value here, right?
All
right. I want to thank the community for showing up. We had 50+ people here today. Awesome. It never goes unnoticed. You take an hour in the middle of your workday to join us. So we never take that for granted. On Tuesday, we're doing a topic that has been requested multiple times by the community. And we know that every time that they request it, they show up for it. It's the property turn show. What happens on a property turn? What are your options? How does it feel? We're going to have Allie King here to talk about that. She handles all that stuff for JWB. In the meantime, if you want to allocate into this investment class, go to chatwithjwb.com. That first call is all about where you're able to pull money from in order to allocate this. Normally, they're able to find more things that you thought you had options to and show you exactly just how much harder your money is going to work for you when you come into real estate versus other assets. So go to chatwithjwb.com, plan a call, and until next time, don't be average. See ya.